The first fact is that money is not coins or paper, but a technology for recording trust. Historically, people used various items: cowrie shells, salt, furs, and grain. Later, metal coins were introduced, and then paper receipts from merchants and the first banknotes, which were essentially debt acknowledgments. As states developed, the power to mint and issue money became a state monopoly. Since the 20th century, most currencies have not been backed by gold. Their value relies on legal rules, limited availability, and the public's readiness to exchange them for exchange. Today's money is a record in a ledger held by banks and payment systems. Cash is simply a convenient offline version of this record. A significant conclusion is that a currency's stability is a result of its institutions and the trust in them, not the color of the ink on the bill. The second point concerns inflation. Inflation is understood not as a mere rise in prices, but as a decline in the purchasing power of a unit of money. When it is stated that inflation is 6% this year, it implies that obtaining the same assortment of goods now necessitates 6% more money than in the preceding year. Its detrimental effect is amplified by compounding. Even a modest annual price increase, when accumulated over decades, substantially reduces the value of previously held sums. Inflation adversely affects cash savings and fixed incomes, but it benefits borrowers because the nominal amounts of payments stay the same while the money becomes less valuable. There is also a subtle form called shrinkflation, where manufacturers reduce the weight or volume of packaging without an apparent price adjustment. Deflation, in contrast, appears favorable but carries dangers. People delay purchases, the economy stagnates, and debts become more difficult to manage. Thus, moderate, predictable inflation and indexation are essential. Fact 3. Compound interest serves as the main catalyst for both wealth creation and the formation of debt cycles. The process where interest accrues not only on the principal amount but also on previously earned interest leads to exponential growth. The easy-to-use Rule of 72 assists in estimating the duration for capital to double. Divide 72 by the estimated annual yield to determine the number of years. This concept also applies to debts and penalties. Credit cards with elevated interest rates can convert a minor borrowing into a protracted period of obligation if only minimal payments are made. Commencing early is of paramount importance. A year secured at the outset carries more weight than a year appended at the conclusion of the time frame. Charges and taxes diminish the impact, thus emphasizing the significance of low expenses and tax-efficient instruments where legally permitted and obtainable. The mathematical principles remain constant, yet the final results differ. The fourth point is that a budget serves not as a prohibition of pleasures, but as a plan for priorities, with pay yourself first as the initial item. The pay-yourself-first method entails automatically transferring a portion of income to savings and objectives immediately upon receipt of funds. Consequently, the remaining balance adapts to your lifestyle, rather than the reverse. The zero-based budgeting approach allocates every dollar. Any amount not designated will be spent. The envelope system creates psychological friction. Distinct wallets for food, transportation, and entertainment offer clear indicators when spending should cease. The 50-30-20 rule is a flexible template, not an unchangeable dogma, intended to be modified according to one's reality. It is essential to factor in irregular expenditures. Technology malfunctions, taxes become due, vacations occur. These necessitate their own allocated funds. Automation minimizes lapses, and daily oversight functions not as micromanagement but as a feedback mechanism. The fifth point is about the reserve fund. It functions as personal insurance against disorder, not as dormant funds. Its objective is to create time. to allow for a calm search for new employment, to recover from sickness, or to address unexpected home repairs without resorting to debt. The common guideline suggests maintaining funds equivalent to 3 to 6 months of expenses. For those with variable income, it's recommended to extend this coverage to 6 to 12 months. The principles for this fund are clear: utmost liquidity and minimal risk. This implies opting for highly dependable accounts or savings with swift access, rather than assets prone to market fluctuations. It is prudent to keep this fund distinct from daily expenses and separate from investment portfolios to prevent the impulse to use it for current needs. Counterintuitively, even a modest reserve can decrease feelings of worry and enhance the quality of one's choices. When immediate danger is absent, the necessity to liquidate assets at their lowest points or to secure expensive credit is eliminated. The sixth fact is about insurance, functioning like a seatbelt for your personal finances. It's not designed to make you wealthy, but to prevent financial catastrophe when an infrequent but expensive event disrupts your plans. The core idea is simple. Events that are rare and very costly are best passed on to the insurer's books. This includes medical issues, loss of earning capacity, death or damage to your home, and liability to third parties. Frequent and inexpensive events are more sensible to cover with your own savings. Key terms in a policy are the deductible, limits, and exclusions. A higher deductible reduces your premium but increases your out-of-pocket expenses. Limits establish the maximum payout, and exclusions define what isn't covered. Understanding waiting periods and payout terms is crucial, as is keeping copies of documents and property photos. A policy with unclear conditions is merely an illusion of protection. A policy fitted to your family's and region's risks is a tool for resilience. Seventh point, diversification isn't about acquiring numerous items. It's about spreading capital across risk sources that act differently. Stocks, bonds, cash, property, and worldwide alongside local markets, their returns don't move together. This lack of synchronization smooths out capital's path. Yet correlations aren't permanent. During crises, they tend to become one, making the portfolio fall all at once. Thus, cash and good bonds are vital as shock absorbers. Rebalancing brings back target shares. Sell what grew, buy what dropped, mechanically selling high, buying low. Costs and taxes matter. Rare, steady rebalancing is cheaper than constant activity. Low-cost index funds are often the foundation, with riskier ideas added on top. Fact number 8. The psychology of money holds more sway than a calculator. We spend more when using a card than cash because the pain of payment is lessened. A today-only discount triggers the fear of missing out. The buy now, pay later method hides the true cost. The anchoring effect makes us accept a price shown next to a clearly overpriced one. Loss aversion makes us keep unprofitable assets until they're worth nothing. Mental accounting creates fake pots where earned money is spent impulsively. Practical solutions are simple. Pause before a big purchase, use lists and limit impulse spending sources, set up auto transfers for goals, keep accounts physically separate, and cool off your cart for a day. Looking at the yearly financial picture once a month helps to reduce emotional impact and restore balance to decision-making. Fact 9. Credit is essentially paying for the privilege of having something sooner. You get the item now and pay for it later. The extra amount you pay due to this time difference is your interest. When evaluating a loan, look beyond the advertised interest rate to its true cost, which includes fees, insurance, and how interest is calculated. With annuity payments, early payments are mostly interest, meaning the main debt reduces slowly. Paying off the loan early, especially in the first half of its term, significantly cuts down on the total interest paid, as long as there are no early repayment penalties. Mortgages are secured by collateral, and the loan amount is compared to the collateral's value. A higher LTV means a higher interest rate and stricter loan conditions. A fixed interest rate offers predictable payments, while a variable rate means your payments could go up if market rates increase. Credit cards are a very expensive way to borrow money, second only to penalties and payday loans. The interest-free period on a credit card is only useful if you pay the entire balance before it ends. Otherwise, compound interest will start working against you. Fact number 10 focuses on taxes, which constitute an additional stratum of personal financial reality. The specific tax regulations are jurisdiction-dependent, yet common principles are recurrent. Taxes are levied on income, capital gains, dividends, and property. Furthermore, systems offering tax deferral and tax deductions exist, along with progressive tax rates and established thresholds. The process of reporting, providing supporting documentation, and maintaining records of the cost basis and holding periods for assets dictates the net proceeds from a transaction. Assets held for extended durations are frequently subject to more favorable tax treatment than those held for shorter periods. The strategic transfer of assets between accounts that provide tax benefits and those that do not can influence final returns as significantly as a judicious choice of investment fund. It is imperative that tax optimization strategies are both lawful and clear, as the financial consequences of mistakes, in the form of penalties, can negate any accumulated savings. The overarching advice is uncomplicated. Plan financial operations with a clear understanding of their tax implications beforehand and consult reliable sources for accurate information regarding the rules in your specific country. Fact number 11. High earnings and being wealthy are not interchangeable terms. The growth of capital is not determined by the number on a salary slip, but by the disparity between income and expenses. This disparity is referred to as the savings ratio, and it proves more effective than any so-called secret strategy. Consider two individuals with identical incomes. One might consistently allocate 30% of their earnings to automatic transfers for various objectives and investments, whereas the other might spend nearly all of it, elevating their spending habits with every salary increase. After a period of several years, their net worth, which is the sum of assets minus liabilities, will present a stark contrast. The phenomenon of lifestyle inflation often infiltrates gradually. This can manifest as new subscription services, upgrading possessions simply because one has the means, or developing a tendency to pay a bit extra for convenience. The remedy involves implementing deliberate constraints, ensuring that spending on enjoyable activities does not escalate at a pace exceeding inflation, strategically pausing expenditure levels when income increases, and conducting regular assessments of one's net worth beyond just reviewing bank transaction records. Income functions as a stream, while wealth serves as a reservoir. Fact number 12 states that financial objectives are effective when they possess a specific address, a set time frame, and a measurable method. The statement, "I'm saving for everything," lacks clarity. Whereas, within 18 months, to make the first payment for a home, I need roughly this sum, and I will set aside this much each month. A convenient framework for goals is structured like buckets. Short-term goals, spanning up to 2 to 3 years, are managed using highly liquid and low-risk instruments. Medium-term goals are pursued with instruments exhibiting moderate volatility and defined timeframes. Long-term goals, extending beyond 5 to 10 years, are invested in market assets where price fluctuations are expected, but the compensation for patience is higher. The inclination towards present bias pushes for immediate benefits. Automating contributions and visualizing the progress achieved help to counteract this. Conducting a quarterly personal board of directors meeting is beneficial for reviewing the sum, timelines, and assumptions, and for making course corrections without undue stress. A goal is not required to be permanent, but any modifications should be well considered rather than a response to a news report. Fact 13 emphasizes that investing is primarily about cost management and discipline, with idea selection coming second. Fees are a silent enemy of compound interest. Even small annual percentage differences over decades significantly alter the final result. Index funds and ETFs with low fees are often used as a core holding because they offer broad market exposure without the need to guess which individual stock will perform exceptionally well. While active stock or fund picking can be successful, after accounting for fees and taxes, it struggles to consistently outperform a benchmark, as evidenced by numerous comparative studies. The practical advice is, if you lack the time and expertise, choose a simple and cost-effective core for your portfolio. Market timing may seem appealing, but a considerable portion of annual returns can be attributed to a few significant growth days. Missing these days diminishes an investor's overall return. Consequently, a strategy of time in the market combined with regular additional investments and infrequent rebalancing often proves more effective than constant activity. Fact number 14. Currency risk is a constant factor in our globalized world. You might earn and spend in one currency while investing in assets denominated in another, meaning currency rate changes will affect your overall financial outcome. The core idea is this: your financial cushion and any large expenses planned for the future should be held in the currency you expect to spend them in. For your investments, spread them across different countries and currencies so you aren't reliant on just one company or one country's economy. When you exchange currencies, pay attention to the bid-ask spread and any fees, as a seemingly good rate can often include hidden charges. There are financial tools that offer currency hedging to reduce the impact of these fluctuations, but hedging itself is not free and incurs costs, especially when used for extended periods. Currency fluctuations can either increase or decrease your investment returns over many years, and this is to be expected. The crucial aspect is ensuring that the currency risk aligns with your financial goals and the time you plan to invest, and that your strategy is well organized, featuring clear asset percentages, a system for readjusting your portfolio, and disciplined execution. 15th point. Payment safety relies on both habits and technology. Card tokenization and 3D Secure decrease the risk of leaks, but human mistakes cause problems. Examples include fake bank couriers, urgent calls, or links to confirm an operation. These are typical traps. Simple yet effective rules are key. Never give out codes or CVV numbers, don't click links in messages about account blocking, and always call the bank back using the number found on your card. It's helpful to use separate virtual cards with lower limits for subscriptions and online shopping. Instant push notifications and the ability to freeze your card with a single tap in the app are also useful. Avoid transactions on social media. Keep your computers updated with software and use unique passwords, storing them in a password manager. Enable two-factor authentication. Review your statements at least weekly, as there are deadlines for disputing transactions. For travel, have a backup card and copies of documents. For transfers, send a small test amount before a large one. The risk won't vanish, but it can be managed. Fact 16. Pension planning is a project that lasts for decades, with key variables being the time horizon, the desired income replacement ratio, and the tolerance for volatility. The further away the retirement date, the higher the allocation to stocks a portfolio usually has, and risk is reduced as the goal gets closer. This is known as a glide path. The risk of return sequence is crucial. Two portfolios with the same average return can lead to different results if the early years of retirement fall during a market downturn. The solution involves having a liquidity reserve for 2 to 3 years of expenses, a flexible withdrawal rule, reducing withdrawals in poor years, increasing them in good years, and annuities or pensions where they are clear and have a solid issuer. Adjusting spending for inflation is a must. The mix of expenses changes, and the costs of medicines and utilities rise differently than travel expenses. Retirement isn't just about money. It's also about structuring time. The clearer the daily plan and income sources, the more stable the budget. Fact 17. Real estate is often seen as a rock-solid investment, but its profitability isn't just about price appreciation as depicted. It's about the net cash flow, considering all unseen expenses. These include taxes, insurance, repairs, periods of vacancy, agent commissions, moving costs, and loan interest. All these reduce the real return and require a liquid buffer. A home for living is a consumer good with an emotional aspect. A home for investment is a project with a calculator, where capitalization rate, payback period, and exit scenarios matter. Liquidity is lower than for securities. A deal drags on for months and depends on the market. Renting versus buying is not an ideological choice, but a comparison of the opportunity cost of capital and mobility. Sometimes it's cheaper and more flexible to rent, investing the difference in diversified assets. Markets are not uniform. Average across the country hides districts and streets where rules change on the next block. The 18th point is that the main asset for most people isn't their financial portfolio, but their human capital. This includes skills, reputation, health, the ability to learn, and the capability to sell their expertise. The income from this asset is a stream that can be grown through training for specific tasks, getting certifications, learning languages, negotiating pay, and collecting proof of value like results, metrics, and case studies. The return on investing in skills is often better than the market rate. One good skill update can raise your pay for years. You can also diversify your income. Have a main job plus freelance projects, get royalties, own stakes, or create your own products, as long as your health and main income source aren't harmed. Your network of contacts is a multiplier. Weak ties often bring new opportunities if you keep them up naturally without spamming. Also, professional risk management means having backups, insurance for your ability to work, regular health checks, and ways to avoid burnout, because when your body stops, your cash flow stops too. The 19th fact emphasizes that debt repayment strategies are most successful when they integrate financial calculations with psychological elements. The avalanche technique involves directing any surplus funds toward the debt carrying the highest effective interest rate, which serves to minimize overall repayment costs. The snowball technique prioritizes paying off the smallest debts, fostering a swift sense of achievement and freeing up payments for subsequent obligations. Both of these methods require a fundamental setup, setting consistent minimum payments for all outstanding debts and establishing a contingency fund for minor unexpected events, ensuring that a new penalty does not render all efforts futile. Pursuing negotiations with creditors, such as debt restructuring, rate reduction, or payment deferral, can be advantageous. However, one should avoid miracle consolidations that lack clear terms and microfinance organizations with undisclosed fees. Refinancing mortgages and car loans is advisable when it results in demonstrable savings on the total expense and involves practical repayment periods. The single most important rule is to halt the accumulation of new debts until existing ones are completely resolved. Otherwise, any strategy will be ineffective in filling a bucket that has a leak. Fact 20. Protecting a family's finances requires documents as much as it requires money. A will, instructions for accounts and beneficiaries, powers of attorney for incapacity, and guides for digital assets and passwords help remove legal ambiguity and expedite access to funds during difficult times. Life insurance protects against the risk of a provider's early death. Covering several years of family expenses and substantial debts is adequate. An excessive coverage amount is an overpayment for peace of mind, and insufficient coverage is a false economy. It is essential to keep all relevant documents together: copies of policies, a register of accounts, consultant contact information, and a step-by-step plan for what to do in case of emergencies. Parents should arrange for guardianship in the event of simultaneous demise, and business owners should ensure legal access for partners to operational accounts. An annual review of these documents aligns the sums and composition of assets with current life events. A new child, increased income, or a change of address all require corresponding document updates. Fact 21. The complete cost of owning an item is almost invariably higher than the price displayed. A car serves as a typical illustration. In addition to its price and credit, you'll encounter mandatory and optional insurance, taxes, and vehicle inspections. Parking, tires and their seasonal replacement, scheduled maintenance, unexpected repairs, fines, reduced resale value, and even the time dedicated to these matters are all part of the expense. The most substantial hidden cost is depreciation. New cars lose value most quickly in their early years, and this loss can surpass fuel expenditures. For gadgets, software subscriptions, accessories, screen repairs, and rapid technological obsolescence are additional costs. For homes, expenses include utility bills, furniture, insurance, security deposits, commissions, and costs incurred during periods of vacancy when moving. A prudent approach involves calculating expenses over the entire period of use, how many kilometers, hours, or years you will realistically derive from a purchase, and the cost associated with each. Thus, what seems cheap can sometimes prove expensive, and renting can be a more sensible option than buying. Fact 22nd. Opportunity cost is the hidden price tag of any decision. By choosing A, you automatically give up B and its benefits. Holding a large sum of cash may seem safe, but the cost is missed compound interest and the impact of inflation. The perennial argument of paying off a mortgage versus investing is settled by comparing after-tax outcomes and considering risk. Guaranteed savings on high-interest debt is risk-free return that the market finds hard to consistently beat. For low-interest loans, the arguments are closer, and liquidity, funds and assets are accessible, not at home, and psychology, freedom from obligations, also has value. The initial data table should include the rate, time horizons, a reserve for emergencies, and the discipline of contributions. The universal conclusion is straightforward and potent. First, clear the most expensive debts, then resolve the balance between accelerated repayment of cheaper debts and investing in a diversified portfolio. Fact 23rd. A credit history serves as your financial reputation in numbers, determining your access to borrowing, the interest rates applied, and sometimes even conditions for renting or insuring. The basic elements are similar in various countries. On-time payments, the proportion of credit limit used, lower is preferable. Stable figures up to 30% and even more secure, up to 10%. The age of your credit history, older accounts are highly valued. The range of credit products used and recent applications. Closing an old card can abruptly shorten the average age of your accounts and negatively affect your credit picture. Conversely, sudden increases in credit limits before a major loan might appear concerning. It is beneficial to request your report once a year, check for errors, and contest them with documentation. If you have no credit history, you can establish one by responsibly using a small credit card with automatic full balance repayment. The primary rule is consistent across all models. Discipline and predictability are more valuable than any life hacks, and a delay of just a couple of days can require months to recover from. Fact 24th. Subscriptions are evolving into a new form of recurring charge, subtly increasing from a multitude of low-cost services. Trials that automatically renew, yearly setups instead of monthly ones, convoluted cancellation methods, discounted bundles you won't utilize. These are typical attention economy ploys. To avoid money disappearing, create a record of your subscriptions, noting the cost, payment date, and cardholder. Set up alerts 3 to 5 days prior to renewal. Utilize a distinct virtual card with a limited balance and instant alerts. Examine your bank statements weekly and conduct a spring cleaning quarterly. Deactivate anything you're not using. When switching plans, save screenshots of the terms. If prices go up, look for alternatives instead of paying out of inertia. The latte effect concept might overemphasize small expenditures, but regular subscriptions are not minor. They are a foreseeable cash flow that either benefits you or contributes to another's earnings. According to the 25th fact, financial education for children originates not in school but in the kitchen through clear family money policies. Pocket money functions as a tool, not as a bribe. A consistent sum provided on a schedule aids in learning planning better than the method of asking for it when needed. The three-jar system is functional. Designated for spending, saving, and giving, this cultivates a sense of priority and empathy. A family bank offering fair interest on long-term objectives illustrates the principle of compound interest. Compensation for specific projects instead of basic chores explains the correlation between value and reward. A youth card with spending caps and notifications makes expenditures transparent and safe. Together, examine receipts, game subscriptions, streamer tips, and compare prices and sales. Safety is a crucial lesson. Refrain from sharing codes, differentiate advertisements from advice, and identify fraudulent schemes and phishing. In this manner, you nurture not rich children, but adults for whom money is a tool, not their owner. Fact 26. An irregular income stream is not a budget death sentence if you first average your cash flow. The core strategy involves setting a minimum monthly salary transfer for yourself and then tailoring your expenses to fit this amount. Any income above this minimum should be directed into a buffer. This buffer should be equal to at least 3 to 6 months of your average income and kept separate from your emergency reserve fund. The buffer is designed to smooth out seasonal variations, while the emergency fund is for protection against unforeseen major events. Taxes should be automatically put aside with every payment received, using a fixed percentage mandated by your country's laws to ensure quarterly tax payments are manageable. Client agreements should clearly outline terms up front. Advance payments, payment schedules like Net 1530, penalties for overdue payments, and acceptance criteria. Invoices are to be issued immediately after a stage is completed, and payment reminders should be automated. A financial cushion, combined with liability and health insurance, reduces the risk associated with a major client delaying their payment. Furthermore, a sales calendar essentially serves as your budget but projected forward in time. The 27th fact. Financial fraud rarely looks like a crude counterfeit. More often, it's too good to be true. Promises of high returns without risk, secret arbitrage windows, payments from new participants, and aggressive urgency are red flags. Add to this supposed expertise via fake licenses and reviews, number spoofing, deepfake bank manager voices, and links to messengers instead of official support. In investments, dangerous are closed clubs without transparent reports and custodians, unaudited funds, and give us your money, we trade for you schemes. Finfluencers must label ads and conflicts of interest. Not doing so is a reason to be wary. Check company registrations with the regulator. Don't transfer large sums P2P to strangers. Diversify risks, keep critical assets with reliable providers, not in exotic apps. And remember, a legal product is always explained in simple words. 28th point. A salary offer is treated as a financial statement. It is important to look at the entire package, not just the monthly salary. Understand the difference between gross and net income, fixed and variable pay, as well as one-time bonuses for starting and annual bonuses for results. Shares can come in different forms. Stock options require payment of a strike price and are based on fair value, while RSUs, restricted stock units, do not have a strike price, but vest according to a schedule, often with a cliff period. Taxes and how easily you can sell the shares, liquidity, also vary. Find out the vesting schedule, if there's accelerated vesting when the company is sold, and what happens if the company buys back your shares when you leave. Compare health insurance, extra pay for vacations and sick leave, company contributions to retirement funds, compensation for working remotely and for phone and internet, help with moving and visas, and severance pay if you are laid off. Check the length of the trial period, any non-compete agreements, and your rights to do outside projects. Project these benefits over 3 to 4 years. Create models for stock prices after taxes and compare them to other options. The numbers are key. Emotions just add flavor. Fact 29th. Crypto assets are a highly volatile asset class where financial and digital hygiene are equally important. The rule, not your keys, not your coins, applies to storage. Exchanges are convenient for trading, but storing large amounts is wiser in your own wallet, and the seed phrase should be kept offline and in multiple copies. Hot wallets are convenient, cold wallets are safer. Any QR code and smart contract must be checked twice because transaction irreversibility leaves no room for errors. Stablecoins are not uniform. Some are backed by reserves and reporting, others are based on algorithms and can fail. Research the issuer's risk. Network fees and congestion affect transfer cost and time. Portfolio allocations should be moderate with the idea of how much you don't mind losing because regulatory and technological risks are high. Taxation of operations differs by country and is often unexpected. Record transactions and keep statements. Discipline is more valuable than hype here. Fact 30. Charity and personal finances are compatible. Consistent donations benefit the world and improve your financial discipline. A practical method is to commit to donating a set percentage of your earnings or a fixed sum on a regular schedule, rather than sporadically. This aids in planning for both charitable organizations and yourself. It is crucial to assess organizational transparency by reviewing their financial statements, stated goals, impact measurements, and independent audits. Popularity is not a guarantee of effectiveness. Employers may offer matching gift programs, effectively doubling your contribution at no extra cost. In certain nations, charitable donations qualify for tax deductions. Ensure you keep your transaction records and understand the local tax laws. Significant philanthropic aims can be arranged in advance through wills and estate planning, earmarking a portion for charity. And during your lifetime, you can utilize funds that manage capital and distribute it for specific purposes. The essential aspect is mindful giving. Support initiatives that resonate with your values and demonstrate tangible results, while ensuring your family's basic financial security remains intact. The 31st fact states that personal finances are manageable when you practice double-entry bookkeeping for your life, comprising a cash flow report and a net worth statement. Each month, you should record all money coming in and going out, limiting categories to 8 to 12, such as housing, food, transport, communication, healthcare, education, entertainment, and other expenses. Concurrently, maintain a separate table for your assets and liabilities. This includes bank accounts, cash on hand, investments, real estate, and electronics, valued at their realistic market price, from which you subtract any outstanding loans or installment payments. From these two financial records, essential metrics can be derived, including your savings rate, your financial runway measured in months of expenses, the percentage of your income that goes towards debt repayment, and your liquidity. It is advisable to set a specific money day each month to complete this financial review in one session, verifying bank statements and receipts, which instills financial discipline. Ensure that all important documents and warranties are kept in a single location, and store digital copies or photos of receipts in cloud storage. This financial speedometer does not offer criticism. Instead, it clearly indicates your financial direction, advising when to accelerate, when to decelerate, and identifying any obstacles preventing you from achieving greater financial height. Fact 32nd. Acquiring a vehicle involves a series of decisions, with preparation being the main way to protect your finances. First, define the door-to-door budget, including registration and insurance, not just how much per month. Focusing on monthly payments benefits the seller. Getting pre-approved credit from an independent bank or being ready to pay cash sets the upper spending limit and reduces the chance of being pushed into expensive terms. For a new car, look for discounts on last year's models and avoid mandatory extras. For a used car, check its service history. Verify the VIN for restrictions. Test the cold start. Drive it at different speeds and have an independent mechanic inspect it before paying a deposit. Read the contract carefully. Check refund policies for deposits, penalties, deadlines, and the equipment list in the specs. Treat extended warranties and rust-proofing as separate purchases, comparing their cost to the risk of a breakdown. Before the deal, ask for insurance and tax estimates so the nice price doesn't become expensive ownership the next day. The 33rd point is an investment, and its return should be calculated, not assumed. The cost isn't just tuition and living, it's also the opportunity cost of your time, what you could have earned working instead. Income isn't just average graduate pay, it's your actual increased income in your field and region, after taxes, adjusted for how likely you are to get a job. It's helpful to plan for 3 outcomes: a standard case, a best case scenario, and a worst case scenario, considering the risk that the program might not pay off right away and might require internships. You can lower costs with grants, scholarships, employer agreements to cover expenses, interchangeable certificates, and online courses that fill gaps without stopping work. Education loans should be taken with a clear understanding of the total cost and the maximum payment you can afford based on your income. A key indicator is the market signal, the demand for skills, what graduates' portfolios look like, and what employers say. Not all prestigious things are valuable. Value is where your skills turn into money. The 34th point is that moving to a new city or country is a financial journey, with numbers forming its foundation. The comparison isn't about gross salaries, but the net amount left after taxes and standard costs. These costs cover rent and deposits, transportation, utilities and communication, food, medical expenses and insurance, plus kindergarten and school fees. The plan includes costs for temporary housing during the move, shipping belongings, round-trip travel tickets, fees for paperwork and translations, and bank or service provider charges. If your income and spending are in different currencies, you face currency risk. This can be managed by spreading your savings across different currencies and accounts and by using conversion methods with minimal price differences. You need to understand tax laws, agreements to avoid being taxed twice, reporting deadlines, and registration requirements. Social capital also has a monetary value. Not having a local credit history can mean larger deposits and tougher terms, but this can be balanced with documentation and proof of steady income. A plan based on figures removes unrealistic expectations and allows for genuine choice. 35th fact. Small businesses and freelancers operate based on cash flow. Paper profit won't save you if your account is empty. The first rule is financial separation. Use separate accounts, cards, and bookkeeping for your company and personal life to track margins and manage taxes correctly. Pay yourself a fixed salary on a schedule. Allocate the rest to expenses, taxes, and a reserve of 2 to 3 months of business operating costs. Issue invoices to clients with clear work stages, advance payments, and terms like net 15/30. Automate reminders and track outstanding debts by aging them to avoid missing due dates. Aim to keep fixed costs lean. Rent with flexible terms, lease equipment instead of buying, and subscribe only to essential services. Compare acquiring and payment processing fees across your entire transaction volume, considering rates, refunds, and chargebacks. Liability insurance and basic cyber hygiene protect against infrequent but costly incidents. A business is also a portfolio. The key is not growth speed, but survival during tough times. The 36th point is about a goal piggy bank or sinking fund. It's the opposite of the urge to get a loan and sort it out later. The basic idea is this: big, predictable expenses are split into monthly payments made long before the actual event. This money is kept in its own account, separate from your daily spending. This is how you pay for holidays, new gadgets, insurance excesses, taxes, presents, or home improvements. Anything that isn't happening right now, but definitely will happen. Unlike an emergency fund for unexpected things, a goal fund is for things you can see coming on a calendar. The best way to do it is to name each goal, set the amount and date, Set up automatic transfers for when you get paid, and then adjust your regular spending with what's left. This has a big psychological effect. The money is marked for its purpose, and you won't want to spend it on anything else. It's good to keep short-term goals in an account that's easy to access, and medium-term goals in investments that have very little risk and a small profit to keep up with rising prices. Here, being disciplined takes the place of paying interest to a bank. You're paying yourself instead. Fact number 37. Negotiating prices should be viewed as a process of finding mutual benefit rather than a conflict. Many businesses and service providers build flexibility into their pricing. This can manifest as seasonal discounts on previous year's stock, demo units, or floor models, special bundle offers such as 2 for 1.5, or complimentary delivery in lieu of a direct price cut. It is wise to ascertain the fair market value in advance by consulting price comparison sites, reading user reviews, and examining average industry prices, thereby preventing the imposition of an unfavorable starting price. When inquiring about costs, it is effective to ask about the total expenditure. Could you please provide the total cost, including registration, insurance, delivery, and any associated fees? The principle of BATNA, or the best alternative to a negotiated agreement, is valuable. Having secured a pre-approved loan or a comparable offer from a competitor gives you the leverage to walk away if the terms are not improved. A quiet yet potent strategy involves pausing and demonstrating a willingness to delay the purchase. For services, pricing structures often reflect volume and predictability. Entering into a long-term contract, agreeing to flexible delivery schedules, or referring new customers are all valid justifications for seeking a discount. The most crucial elements are mutual respect and clear objective criteria. While emotions may fluctuate, concrete figures remain constant. Here is fact number 38. Bonds are essentially a loan you give to an issuer, and you get coupons and the face value back when it matures. But their safety is not the same. There are two main risks: interest rate risk and credit risk. When market rates go up, prices of existing bonds go down. The longer the duration, meaning how sensitive it is to rates, the more it falls. Long-term bonds, which are usually a safe haven, can suddenly become choppy, and this is normal market behavior. Credit risk is the chance that the issuer won't pay or will pay late. This is judged by ratings and the difference in yield compared to risk-free bonds, and you spread it out across different bonds and industries. You calculate the return based on yield to maturity, not just the coupon, factoring in the buying price and all payments. Short, safe bonds help absorb shocks in your portfolio. Long ones give more return but move around a lot. High-yield bonds offer more reward for risk, which might happen. Your choice depends on what you need: a cash buffer, a stable part of your portfolio, or betting on interest rate changes. Fact number 39 addresses how travel affects your wallet, not only due to prices, but also payment methods. Terminals frequently propose charging in your domestic currency, which is dynamic conversion and usually carries a hidden fee. It is better to select payment in the currency of the country you are visiting. Foreign ATMs often push suggested rates. Decline these and let your bank convert the money using its own policies. Taking cash from credit cards can cancel your interest-free period and add charges. It is wiser to use a debit card with sensible limits, transaction alerts, and a backup card stored elsewhere. When you book or rent a car, deposits are held. Remember to check your available funds and how long it takes for them to be returned. Using data while roaming is also a financial matter. Get data plans ahead of time to avoid paying for each use. Health insurance with clear limits when overseas can save you a lot of money if something happens. To conclude, here's a simple list: copies of your papers, your bank's phone number, maps you can use without internet, and some local cash. The fact number 40 underscores that money matters in relationships are less about joint or separate and more about the structure of trust. Three functional models are presented: a completely communal budget, entirely individual finances, and a mixed approach featuring three distinct pots. Under the mixed model, a mutually agreed upon percentage of funds is directed toward collective aims, while personal expenditures are not subject to scrutiny. The cornerstone is openness. This involves maintaining a record of accounts and liabilities, setting objectives, securing insurance, and formulating a plan for unexpected events. It is vital to establish ground rules for money talks. Engage in discussions during calm times without assigning blame, concentrating on present data and future prospects, not on past missteps. A monthly family council should convene to review the budget, assess progress toward goals, deliberate on substantial acquisitions, and implement any required changes. The assignment of roles does not confer dominance. The partner responsible for financial tracking does not gain control over the funds. Decisions are reached collectively. Indicators of concern, such as concealed debts, denial of access to money, or the imposition of credit, signal financial control, which demands the establishment of boundaries and, if needed, support. Finances that are properly organized within a couple amplify freedom rather than diminishing it. Fact 41. Dividends are not gift money. Instead, they are a method of returning capital to shareholders, and their impact on the overall financial situation is only apparent when viewed with the stock price. On the date dividends are paid out, ex-dividend date, a stock's price typically declines by an amount close to the dividend payment. This adjustment considers taxes, the general market environment, and any relevant news. The reason for this is that the company's cash reserves decrease by the dividend amount, while the shareholders' cash holdings increase. The total value of the investment does not grow. A high dividend yield can frequently be an indicator of underlying issues. The yield appears high because the stock's price has fallen due to negative expectations about the company's future, which is known as a dividend trap. Companies designated as dividend aristocrats are characterized by disciplined management, but this does not guarantee extraordinary profits. A more significant measure is the total return, which includes both the increase in stock price and the reinvestment of dividends, DRIP. The approaches of living off dividends and selling a portion of shares are economically comparable, assuming similar levels of risk and taxation. The differences are primarily psychological and related to tax specifics. Share repurchases, buybacks, serve as an alternative to dividend distributions, but their effectiveness is dependent on the company's valuation. Repurchasing shares at an inflated price leads to a destruction of value. Fact 42. Leasing, credit, and rental represent three distinct approaches to asset utilization, differing in their flexibility. Credit is essentially buying in installments. You incur interest charges but become the owner, assuming the risks of resale and value depreciation. Leasing involves a contract for a defined period with a pre-established residual value. Monthly payments are generally lower and the initial outlay might be reduced. But it includes restrictions on mileage or wear, penalties for early contract cancellation, and a buyout option at a predetermined cost. This is advantageous if you plan to upgrade your vehicle or equipment every 2 to 4 years and prioritize cost predictability. Rental provides the utmost flexibility, enabling usage without ownership and eliminating resale responsibilities. But it comes with the highest cost per unit of time. In total cost of ownership, TCO, all payments, insurance, usage caps, taxes, and penalties for exceeding these limits are factored in. For businesses, accounting and tax implications are also relevant. Operational leasing can sometimes benefit a company's financial statements and cash flow. The final choice is determined by your investment horizon, usage patterns, and your comfort level with the risk tied to the asset's residual value. The 43rd fact states that concentrating capital in your employer company is a double risk. Your income and your assets rely on one source. If the company faces trouble, you risk losing your job and seeing stock prices fall or bonuses vanish simultaneously. This is the double impact. Attractive discounts in shared purchase plans, large RSU or options, and brand loyalty can encourage holding company stock, but discipline should override emotions. A wise upper limit for your employer's stake in your net worth is 5 to 10%, sometimes 15% for large established companies. Diversify the rest systematically. Practically, sell some stock automatically when it vests and transfer it to an index fund. Observe blackout periods before earnings reports and keep reserves in separate accounts, not your employer's bank. For ESPP, use the discount as a free lunch, but don't hold the position longer than needed. A what-if plan for layoffs and stock price drops is a mandatory document, much like a resume. 44th fact: rebalancing is the consistent return of a portfolio to its target risk allocations. The purpose is to avoid being overly dependent on fortunate outcomes or market declines. There are two primary methods: a scheduled approach, e.g., every quarter, 6 months, or year, and a trigger-based approach, when an asset class's allocation moves outside a predefined range, such as a 5 percentage point deviation from the target. A common strategy is a hybrid: review on a schedule, but execute trades only when a threshold is crossed. For taxable accounts, initial rebalancing is soft, using new contributions and dividend reinvestment to minimize asset sales. Selling is a final step, with commissions taken into account. An additional strategy is tax loss harvesting. This involves selling a devalued asset and purchasing a closely related one. Ensuring it's not identical to adhere to regulations on substantially identical purchases. Country-specific rules apply. Rebalancing is more straightforward in tax-advantaged accounts, as taxes do not interfere with maintaining discipline. The core objective remains constant: to maintain risk within defined parameters and to mechanically sell assets when they are expensive and buy them when they are cheap. The 45th point is that gold functions not as a wealth creator, but as protection against particular outcomes. It does not generate income, so its returns over the long haul are influenced by market sentiment, real interest rates, and currency strength. At certain periods, gold serves as a shield against inflation and financial pressures, while at others, its price remains unchanged for extended durations. There are different methods of owning gold. Physical bars and coins necessitate storage and involve a price difference when transacting. Coins collected for their numismatic appeal often have an additional cost that is separate from the metal's inherent value. Gold-backed exchange-traded funds offer ease of use and liquidity but incur management fees. Gold held as paper without physical delivery exposes the holder to counterparty risk. The typical allocation within a portfolio is modest, usually between 5 and 10%, acting as a safety net and a diversifier that can sometimes increase in value when the stock market decreases. The essential aspect is to understand its purpose. Gold cannot replace an emergency savings fund. It is not inherently designed to outperform the market, and it requires the same principles for managing costs and rebalancing investments. Fact 46. Inflation-protected bonds are a type of investment where the basic structure of a traditional bond is augmented with index-based protection. The nominal value of these instruments is regularly adjusted to the official price index with a time lag. The coupon interest is calculated on this adjusted nominal value, allowing the investor to achieve a real return that exceeds inflation. If inflation goes up, the indexed face value and the payments made will follow this trend. If inflation goes down, the protection is reduced, and in cases of deflation, the indexing might result in a decrease of the nominal value, depending on the specific issuance conditions. There are associated risks, such as reliance on the method used to calculate the index. The consumer basket may not reflect your personal expenses. The taxation of index-linked increases before the bond is actually redeemed in certain tax environments, and sensitivity to real interest rates. When real rates increase, the market price of these bonds tends to fall. In practical terms, these are not a foolproof solution, but rather a foundational element for long-term investment portfolios where maintaining purchasing power is crucial. Shorter-term bonds help reduce volatility, while longer-term bonds are more responsive to changes in interest rates. Fact 47. Both dollar-cost averaging, DCA, and lump sum investing are methods for deciding how to allocate a significant amount of capital over a period. In markets that experience consistent growth, investing the entire sum at once typically yields better results because the capital is invested for a longer duration. However, psychological considerations and the fear of investing at a market high point make DCA a more robust strategy. DCA works by dividing a large investment into equal portions invested at regular intervals, thereby decreasing the probability of substantial regret and fostering disciplined financial behavior. For a one-time investment, a possible strategy is to invest one-third of the sum immediately and then invest the remaining portion over a period of 6 to 12 months following a fixed schedule and disregarding current news. When it comes to regular contributions from income, DCA is automatically implemented and serves effectively as an autopilot for accumulating wealth. A common pitfall is transforming averaging into a perpetual wait for the perfect entry point, resulting in funds remaining uninvested for extended periods and being diminished by inflation. Whatever approach is adopted, adherence to established principles is vital. A predetermined investment timetable, allocation based on objectives and asset classes, infrequent portfolio rebalancing, and abstaining from trying to predict the market's lowest point. Fact 48. Return isn't just one number. It's a distribution of outcomes, and you live within that distribution in your portfolio. Two strategies with the same average can feel completely different because of their volatility, how deep their losses go, and how fast they recover. For goals that are far off, what matters are real numbers after inflation and sequence risk, the order of years with good results versus bad results. For goals that are close, liquidity and predictability are important. Metrics like the Sharpe ratio and Sortino ratio are good for comparing risk and return, but they don't replace common sense. When crises happen, assets that are usually unrelated start moving together. Doing this effectively involves 4 steps. Figure out your goal and how long you plan to invest. Pick a mix of assets based on how much loss you can handle, the sleep test. Calculate all the costs and taxes and decide on a plan for rebalancing. And remember this, most of the success comes not from picking the best year, but from sticking with it and keeping costs low year after year. Fact 49. Cashback, miles, and points function as a loyalty discount. This discount is valid only under one essential condition. The card's balance must be fully settled each month. Failure to do so means that interest charges will cancel out any benefits. The most effective strategy involves a simple setup: 1 or 2 cards for your main spending categories and 1 card for general use with a basic cashback rate. Experimenting with numerous cards creates complexity and raises the risk of payment delays. Welcome bonuses are most beneficial for planned expenditures, not for artificially increasing spending to reach a target. Miles are prone to devaluation, making prolonged accumulation a poor strategy. It is advisable to use redeemed rewards for practical needs, such as tickets or hotel stays, or to reduce your statement balance rather than for purchasing miscellaneous items at inflated catalog prices. Pay attention to fees for international transactions. Opt against dynamic currency conversion and thoroughly read program rules, including any calendar restrictions, partner limitations, and blackout dates. Remember that free cashback is financed through merchant fees, so avoid spending extra money just to earn a bonus. Fact number 50. Medical expenses frequently cause financial shocks, and managing them involves preparation, careful documentation, and early issue resolution. When selecting an insurance policy or a healthcare provider, compare more than just the premium or contribution. Also consider the deductible, co-payments, maximum out-of-pocket expenses, and the network of providers. Treatment outside the network can substantially increase the final bill. It is beneficial to plan for preventive care, such as vaccinations, health screenings, and dental treatments, as these are more cost-effective than treating subsequent health complications. Before any medical procedure, confirm the service codes and if pre-authorization is necessary. Afterward, request a detailed bill, as incorrect coding and duplicate charges are common and can be rectified. Inquire about the cash payment rate, as it can sometimes be lower than the insured rate. It is crucial to keep all relevant paperwork, including EOBs, explanation of benefits, and all written communications, because there are deadlines for disputing bills. When traveling, ensure you have insurance that covers emergencies and medical evacuation. When buying medicines, compare generic options and take advantage of manufacturer discount programs. The aim is not to avoid all expenses, but to prevent a sudden, severe financial blow that happens when health problems and financial difficulties coincide. Fact 51. Bank fees are essentially a tax for not paying attention, which stealthily reduces interest and cashback. Accounts and cards can incur charges not only for monthly service, but also for infrequent operations. Interbank transfers to other banks or regions, ATM withdrawals at non-affiliated machines, card reissuance, paper account statements, inactivity fees, or exceeding transfer limits. Currency conversion is another point of concern. The spread is often embedded in what appears to be a favorable rate, and weekend exchange rates may differ from weekday ones. Packages offered as free if you maintain a certain spending level are advantageous only as long as those conditions are met. If your spending declines, the monthly fee is reinstated, dramatically increasing the annual cost. Interest on remaining balance may have a maximum sum limit or require specific spending patterns. It's important to calculate the true annual benefit, not just the up to 10% advertised. For international money transfers, compare the total expenses, the sender's fee, any correspondent bank fees, and the exchange rate. The final amount is more significant than a seemingly zero charge. A sensible strategy is to assign specific roles to different banks, one for daily payments, a second for savings with interest and limited access, and a third for travel. This approach helps lower both risks and costs. Fact 52. Time stands as the most valuable asset, and personal finance management gains when you assess your hourly cost of life. A simple method involves taking your net monthly income and dividing it by your actual work hours, encompassing your commute, overtime, and any lingering work-related thoughts at home. This calculation yields a guideline. Subsequently, engage in comparisons. If product delivery saves 2 hours and its cost is lower than your hourly rate, view it as an investment in concentration and downtime. Conversely, if undertaking a task yourself consumes a weekend and necessitates purchasing a tool that will see no further use, it represents an expensive DIY choice. Nevertheless, this formula does not negate the importance of sound judgment. Some activities offer returns through skill development and personal satisfaction, such as cooking as a stress reliever or performing repairs to gain a better understanding of your home. The core principle is to prevent the saving of small amounts from resulting in the loss of larger sums. Refrain from waiting in long lines for minimal discounts. Avoid extra travel for cheaper gasoline, and cease endless tariff comparisons in favor of productive work. Implement a decision threshold. If the hourly savings fall below X, I will select the most convenient option, and allocate the reclaimed time towards increasing income, enhancing health, and strengthening relationships. Fact 53. Unexpected earnings, a bonus, a tax return, a gift, or selling an item that's been stored away can easily be frittered away on impulse buys if you don't give them a task in advance. Simple mathematics with flexible shares works. Part is for here and now enjoyment, satisfying a long-standing wish and getting an emotional boost. Part is for the future, topping up your reserve, adding to investments, or settling an insurance plan. And part is for the past, speeding up the repayment of the debt with the highest interest rate. The proportions adapt to your life. If you have more debt, increase the past allocation. If your savings cushion is insufficient, focus on the future. The crucial point is not to transform a one-time gift into a recurring expense. A new subscription, taken out just because, can end up being charged for years. If your bonus is tied to results, you can allocate a portion to training that enhances your chances of receiving subsequent bonuses, a positive feedback loop. And don't forget about taxes and deadlines. Some payouts are taxed differently, so set aside a percentage beforehand to ensure your joy isn't replaced by confusion during the reporting month. Fact 54th. Saving on utilities is not about wearing a sweater, but rather a one-time modernization that generates small dividends over many years. LED lamps last considerably longer and consume significantly less power. Smart switches and timers switch off lights in unoccupied spaces. Heat loss frequently occurs via windows and doors. Installing seals, adjusting fittings, and basic insulation for attics and pipes are economical tasks with rapid payback periods. A thermostat with a schedule reduces heating or cooling when you are absent. Using moderate temperatures for washing cycles and air-drying clothes lowers bills and extends the lifespan of your belongings. New energy efficiency class appliances are pricier at the point of sale, but more economical in the long term. It is important to consider the total cost of ownership, TCO. The difference in consumption over a 5 to 7 year period often covers the initial overpayment. Silent energy drains are electronics in standby mode. A power strip with an off switch can eliminate them during the night. All of these actions are not acts of heroism, but rather systematic minor adjustments that do not compromise comfort, yet safeguard the budget from escalating tariffs. The 55th fact is that tracking mistakes is an undervalued asset in personal finance. We remember our successful deals but forget our missteps, attributing success to our skills and failures to circumstances. A good remedy is a decisions journal. Before making a large purchase, an investment, or taking on debt, write down your assumptions, the alternatives you considered, your criteria for success, and the maximum loss you're willing to accept. After the decision is made and its outcome is known, go back and compare your plan with what actually happened. This kind of post-mortem analysis helps you spot patterns, like buying things impulsively at night, underestimating how long renovations will take, expecting to earn more than you do, or not paying attention to fees. A pre-mortem is also helpful. Imagine that your decision failed and list all the possible reasons why. Often, you'll immediately see what needs to be checked or what kind of backup you might need. It's a good idea to create checklists. For example, for a loan, check the total cost, penalties, early repayment options. For an investment, check expenses, taxes, different scenarios. For a purchase, check total cost of ownership and return policy. Don't be hard on yourself for the world's unavoidable ups and downs. The goal isn't to avoid every mistake, but to make them less costly and happen less often. When there's a lot of chance involved, it's important to judge the process, not just the result. Being disciplined is better than relying on luck over the long haul. Fact 56th. The expense of investing includes not only the obvious broker commissions, but also the hidden costs of the market. Even when trades are free, you pay the difference between the buying and selling prices, the spread. And with active trading, you encounter slippage, where the price changes during the time it takes to execute. There are also fees for holding assets, exchange and clearing charges, interest on margin borrowing, currency conversion fees that include a spread, and fees for withdrawing funds. For funds, these costs are increased by management fees, TER, and other expenses, as well as less visible items such as tracking error relative to an index, internal fund taxes, and the cost of rebalancing. In certain investment approaches, payment for order flow is utilized, which can affect how well trades are executed. To reduce these losses, it is advisable to trade less often. Choose instruments that are easily traded, liquid. Place limit orders for purchases made without urgency. Avoid trading in thinly traded markets during news events and compare all the different fee structures rather than just one appealing figure. The final result is significant over a period of years. Extra small percentages per year are not noticeable on their own but become considerable when compounded. Life insurance is structured into pure protection and hybrid products that build cash value. A term policy is uncomplicated. You pay premiums, and a large sum is paid if death occurs within the policy's term. If no event happens, you get no money back, but the coverage cost per dollar is low. Accumulation and universal products offer a dual purpose: protection and a growing cash value accessible through loans or surrender. However, they often come with high early-year commissions, complex surrender value charts, and internal returns that aren't always clear. The effective rate is frequently much lower than available market alternatives. The main goal, therefore, is to cover risks, with a sum equal to several years of family expenses and major debts for the period until children or a partner reach financial independence. Beneficiaries are named directly on the policy and should be reviewed as life circumstances change. A ladder of multiple terms for decreasing needs can sometimes be advantageous. Investments are better kept separate for easier calculation, comparison, and changes without sacrificing protection. The 58th fact. Factor investing is an attempt to systematically capture premiums associated with stable market characteristics, such as value, companies that are inexpensive relative to their fundamental value, small size, quality/profitability, momentum, and others. It's important to note that these premiums are not guaranteed on an annual basis. They tend to arrive in uneven installments and can lag behind broad market indexing for decades. This approach requires strict discipline. Otherwise, an investor might sell their holdings just before a market reversal. The risks inherent in these factors are substantial. Companies deemed cheap are often inexpensive for valid reasons. Small companies are inherently more fragile, and momentum strategies can quickly fail during market turning points. To mitigate reliance on a single factor, they are often combined. Careful attention is paid to managing costs and tracking error relative to a benchmark index. And investors must accept the likelihood of extended periods of unfavorable performance. The method of execution is critical. Index funds with a clear methodology, a reasonable scope of asset selection, and regular rebalancing are recommended. Investment vehicles described as black boxes with high fees and guarantees of constant alpha should be treated as a warning sign. The fundamental purpose is not to deceive the market, but rather to achieve a different risk structure that at times is rewarded. The 59th fact states that an investment policy is a personal constitution that protects against making emotional decisions during market storms. It should document the objective and time horizon, target asset allocations, rebalancing ranges, contribution and withdrawal procedures, a list of acceptable instruments, and red lines, actions to avoid. A crisis protocol is helpful. If the portfolio declines by X%, new investment ideas should be frozen for 48 hours, selling based on headlines prohibited, and a plan for contributions or rebalancing should be based on preset thresholds. For short-term goals, the liquidity rule mandates holding a minimum of N months of expenses in low-risk instruments. For retirement, a withdrawal strategy and time-based buckets are necessary. Operational details are also included: how to store passwords and access, the location of accounts, and who will execute the plan in case of force majeure. The policy is reviewed annually, ignoring market noise. Changes are made only when life circumstances change, not when moods shift. While an IPS doesn't make a portfolio unsinkable, it significantly reduces the cost of panic. Fact number 60. ESG and responsible investing are concerned with aligning capital with one's values rather than seeking miraculous returns. Various strategies are employed, excluding specific industries, choosing companies recognized as best in class according to sustainability assessments, actively participating in company governance through voting rights and discussions with leadership, and initiating direct impact projects designed to produce tangible social or environmental benefits. Differences in rating methodologies can cause these assessments to vary. The practice of greenwashing arises when promotional efforts surpass factual accuracy. Implementing filters can result in unintended consequences, such as sector imbalances, an increase in tracking error, and, at times, higher associated fees. It is crucial to assess actual data rather than mere declarations. This includes metrics like emissions per unit of revenue, workplace safety standards, the independence of the board of directors, and the transparency of financial reporting. While an investor's preferences are perfectly acceptable, their financial implications must be quantified. How the expected return, risk profile, and overall costs are altered. In this manner, ESG evolves into a considered decision integrated into an established policy and set of goals rather than a fleeting trend adopted within an investment portfolio. Fact 61. Financial well-being is best understood not as a binary state of rich or poor, but as a dashboard featuring several stable indicators. The first is the savings rate, representing the portion of income transformed into capital. Greater consistency in maintaining this rate leads to a more predictable financial trajectory. The second is the debt load, calculated as total mandatory payments relative to net income. Experience suggests that a moderate debt proportion, which doesn't compromise budget flexibility, facilitates a more comfortable financial life. The third is liquidity, defined as the number of months of essential expenses that can be met by readily available reserves. This creates a buffer of time and prevents the making of ill-advised decisions. The fourth is net worth, which is assets minus liabilities, along with its quarterly progression. The fifth concerns expenses, as commissions and spreads can easily diminish the gains from compound growth. The sixth indicator is risk concentration, measured by the proportion tied to a single employer, market, or currency. These figures are not about striving for perfection, but about effective navigation. By monitoring these instruments, you can detect deviations early and adjust your course accordingly. Fact 62. The rules for protecting bank deposits and investment accounts differ. In many countries, personal deposits are protected by government or industry insurance systems up to a specific limit per bank and customer. This protection focuses on safeguarding the initial amount, not on generating returns should a bank face issues. Investments, on the other hand, are not protected from market fluctuations. If stock prices drop, that is your risk. However, risks associated with the underlying infrastructure are lessened through asset segregation by the broker and custodian, restrictions on the broker using your securities for their own operations without your consent, and regulatory measures. On margin accounts, securities can be transferred and reissued. This is a point to pay close attention to. It is wise to spread your investments not just across different assets, but also across different institutions. Keep your funds in portfolio with various providers. Check their licenses and financial reports, and store your statements and agreements offline. Remember that an account labeled safe with a very high interest rate or a miracle broker with an unclear legal standing is a warning sign, even if their platform looks impressive. Fact 63. A mortgage is a long journey where savings are made from small things. Annuity payments are even and convenient, but at the beginning, they are almost entirely made up of interest. Differentiated payments are higher at the start and cheaper in terms of total interest over the whole period. Paying off early is most effective in the first half of the term if there are no penalties, and a faster payment schedule of once every 2 weeks gives an extra 13th payment per year, cutting down the extra cost. Refinancing has a break-even point. Divide all the one-time costs of the deal by the expected monthly savings and compare it to how long you really plan to have the new loan. A low initial payment often means you must get loan insurance, a separate cost in the total expenses. A fixed rate means you know what to expect. A floating rate means it changes with the market. Hybrid products need you to read the fixed periods carefully. And the main thing, you need to calculate everything from start to finish with taxes, insurance, registration fees, and the family's real plans. Fact number 64 states that financial provision for aging parents should commence prior to any incidents occurring. A transparent log of accounts, routine payments, and physician contacts is required, alongside electronic access with differentiated permissions. Powers of attorney for financial and medical affairs compliant with your nation's statutes are also necessary. An instructional guide for situations where a phone is unreachable should be created. It is beneficial to implement limits and alerts for bank cards. Opening a distinct account for daily expenses with a minimal balance is recommended, while substantial funds should be kept in a slow account that lacks a card. A conversation addressing fraud is obligatory. Clients must be instructed to never dictate codes, not transfer funds upon a call, redial the number from the card, and not admit employees without a request. Investigate eligibility for benefits, subsidies, discount schemes for medications, and social welfare support, as these constitute actual financial resources. Should expenses related to caregiving be anticipated, compare various alternatives: employing a housekeeper, utilizing day centers, placing individuals in nursing homes, or arranging paid support from relatives. Formalize arrangements through written contracts, specifying the scope of services and the timetable, and maintain meticulous records. Predictability and documentation contribute to the reduction of chaos. Fact 65th. The laddering technique for deposits and bonds is a way to manage interest rate risk and liquidity without needing to guess future rate movements. Instead of putting all your money into one long bond, you divide the sum into equal parts that mature at different times, perhaps every year for 1 to 5 years. After a year, the first part matures. If rates have gone up, you can reinvest that money for a new, longer term at a higher interest rate. If rates have gone down, the income from the remaining longer-term parts, which you locked in earlier, helps you. This way, you have money available soon without tying it all up for a long time, and you don't risk everything on one rate. For a specific goal, you can adjust the ladder to match a date, like for children's school fees, home repairs, or education costs. It's important to look at details like fees and taxes, how easy it is to take money out of deposits early, and the credit quality and duration of bonds. A ladder doesn't promise the most money at every single moment, but it gives you control, a predictable cash flow, and protection against surprises in the interest rate cycle. 66th point. Managing personal finances during a crisis isn't about panicking. It's about prioritizing payments and assessing your cash flow. The first step is to cover the essentials: housing, basic food, utilities, and commuting costs. All other expenditures should be temporarily minimized. The second step involves an immediate review of your financial obligations. Create a list of your creditors, noting payment dates, interest rates, and any associated penalties. Proactively contact each creditor to negotiate payment deferrals, restructuring options, or grace periods, as these agreed-upon arrangements are more economical than incurring late fees. The third step is a spending freeze. This means pausing non-essential subscriptions and projects, rethinking your purchasing habits, and adopting a cash-only system for variable expenses to improve your financial control. The fourth step is to establish a short-term reserve fund, covering 1 to 2 months of expenses, even if it requires temporarily reducing investment contributions. The aim is to stop relying on credit cards to manage immediate financial shortfalls. The fifth step is to actively increase your income through side jobs, advance payments for work, prepayments, and selling unused possessions. Most importantly, strictly avoid high-cost payday loans. What seems like a short-term solution quickly escalates into a cycle of debt. Fact 67th. Buying secondhand is not a lottery if you factor in depreciation and risks. There are product types where the used market is a smart choice. Cars aged 2 to 4 years, out of warranty but with a clear service record, refurbished gadgets from the maker with a new battery and a year's warranty, solid wood furniture, sports gear without hidden damage, children's clothes, and prams. However, there are items where you should not try to save money. Motorcycle helmets, child car seats with an unknown past, climbing gear, gas and high-voltage equipment, mattresses, and cosmetics. For electronics, use a checklist: serial number/IMEI free of locks, battery and screen tests, check for drop damage, confirm all parts are included, and verify a 7 to 14-day return period. For cars, get VIN reports, check paint thickness, do a cold start test, confirm mileage with service records, and get an independent inspection before paying a deposit. Calculate the TCO, cost of delivery, cleaning/supplies, possible repairs, and no warranty. Pay through safe sites or escrow, meet in a public place, and ensure the contract has ID details and a description of the item's condition. Fact 68th. Cash and cashless transactions are not in opposition but are tools with varied attributes. A card offers protection via chargeback, ease of record keeping, and cashback benefits. However, it can encourage spending without immediate awareness of its impact and is contingent on infrastructure, issues with acquiring systems, ATM withdrawal limits, or anti-fraud blocks. Cash is resilient in offline situations, helps maintain financial discipline when handled directly, and is useful for purchases at markets or for tipping. The downsides are its susceptibility to loss and difficulty in tracking, alongside risks of counterfeits and theft. A prudent strategy involves a mix. For regular purchases, use a card with transaction alerts and a low spending limit. For business travel or holidays, carry a dedicated card with currency conversion charges and a backup card. A small amount of cash in small denominations acts as a contingency plan. Your primary financial reserves should be kept in a secure, highly liquid account, not in a home hiding place. At home, maintain only enough cash for 1 or 2 days for emergency use. During travel, steer clear of dynamic currency conversion and utilize ATMs affiliated with banks, declining their recommended exchange rates. Importantly, security is a consistent practice. Keep your wallet in a front pocket or inside your bag, conceal the PIN entry, and keep your transaction receipts. The 69th point. Maintaining good habits with financial information helps save money and reduce stress. The market is noisy every minute, but valuable information comes out slowly. Checking too often can lead to actions that don't make statistical sense. A good system is to set update times. For example, check news once a day from 2 trusted places. Look at your investments once a month and review your plan once a year. Focus on original documents. Company reports, official announcements from regulators, and statistics are better than what people say on social media. Learn to tell the difference between facts, what people think, and what might happen. For charts, ask about the lines and what they are compared to. For shocking news, ask when it was published and how they found it out. Get good at stopping yourself from acting on a hot tip. Wait 24 to 48 hours before a big deal, ask yourself why now, and check your investment rules. Set up notifications, alerts, for important risk levels or when you need to adjust your investments, not for every small change. Remember that even experts make mistakes often. Doing things the right way, being disciplined, managing costs, spreading your investments, is better than trying to guess what the headlines mean. Fact 70. Capital in closets is essentially frozen funds that can be unlocked by selling unnecessary items. The first step is to conduct an inventory of your belongings, organized by room and category: electronics, apparel, sports equipment, and tools. Assess their marketability by considering brand reputation, condition, and seasonality. For items that are less likely to sell quickly on their own, it is more efficient to offer them as a bundle to minimize transaction time and shipping complexities. Pricing should reflect actual sales data rather than personal expectations. Research completed transactions and account for a discount due to the absence of a warranty. When presenting items for sale, ensure photos are well lit, include close-ups of any imperfections, and provide an honest description. Prepare packaging materials, such as boxes and protective film, in advance, and select a shipping method that includes tracking capabilities. Data on devices must be erased securely. For personal computers, this involves full encryption and system reinstallation. For mobile phones, it requires unlinking accounts and IMEI, performing a factory reset, and deleting the eSIM. Arrange meetings with potential buyers in public, well-trafficked areas or at designated pickup points, and avoid accepting direct card payments. For larger items, utilize secure locker services or escrow accounts. If selling is not feasible due to time constraints, donating items to charitable organizations and obtaining a receipt can potentially lead to tax benefits in jurisdictions where such provisions exist. An additional advantage is that a reduced number of possessions leads to lower expenses related to storage and relocation. Fact 71. Subtle cognitive traps can negatively impact personal finances, with sunk costs being a primary culprit. This refers to the situation where, having already invested money and time, one feels compelled to continue, despite the inability to recover the initial outlay. An example is a prolonged and doubled-cost renovation project, leading to the thought, "I'll put in more, since so much is already invested." Rationally, however, one should only compare the future costs and benefits of alternative actions: completing the project, switching contractors, halting progress, or selling the asset as is. The endowment effect also contributes, making owned items appear more valuable than their market worth, prompting the retention of unprofitable assets or belongings just in case. When combined with status quo inertia, this leads to stagnant decisions. Effective remedies are practical: the look-forward rule, ignoring past spending; a stop-loss mechanism for projects, a loss threshold that mandates a review; a pre-mortem assessment, why might this fail; and an external, unemotional review of financial figures. The earlier an error is acknowledged, the less costly it proves to be, both financially and psychologically. Fact 72. Salary negotiations are a project built on data and timing, not just a simple request for more money. Preparation involves market benchmarking. Research your role, grade, region, and the median salary range to establish your starting point, rather than letting the employer set it. The second phase is to analyze the total compensation package. This covers your base pay, bonuses, company stock or options and their vesting schedules, signing bonuses, additional pay for remote work or relocation, education support, medical insurance, vacation time, and severance pay. Remember that one element can be traded for another. The third phase is to demonstrate your value. Create a list of your achievements with quantifiable before and after metrics. Detail your projects, any savings you've generated, and new responsibilities you've assumed. Present this information on a single page. The ideal timing for these discussions is either before the annual budget cycle or following a strong financial quarter. Your phrasing should be direct. Considering the market and my contributions, I am requesting a salary review to a compensation package of. If flexibility is limited, propose alternatives. If the salary range cannot be increased, let's discuss a one-time bonus, a change in job level, RSU or options, or remote work arrangements. Staying calm and being prepared with a BATNA, best alternative to a negotiated agreement, will enhance your success. It is essential to have the final agreement documented in writing to prevent any misunderstandings about what was settled. Fact 73. The choice of an insurance franchise is a balance between a low monthly contribution and the amount of risk you are willing to bear. A high franchise considerably lowers the premium, but it demands a cash reserve as you pay the initial part when an event occurs. If accidents or breakdowns are infrequent, the savings on contributions over the years will cover the occasional self-payments. However, if the risks are higher, a novice driver, frequent journeys, areas with natural disasters, an inflated franchise is risky. It is helpful to calculate the break-even point. How many months of saved contributions cover the franchise difference? In car insurance, pay attention to glass, towing, and courtesy cars. In home insurance, consider floods, fires, neighbor liability, and utility wear. Usage-based policies exist. Careful driving reduces the price, but share only acceptable data volume with the provider. Always keep photos of property and receipts. Payout disputes are won by documents, not emotions. Fact 74th. Home improvements represent one of the most underestimated financial endeavors. The budget almost invariably expands if no contingency is built in. The established practice is to add 10 to 20% for unforeseen events and to define the work scope rigorously, detailing included tasks, materials, delivery arrangements, schedules, and acceptance benchmarks. It is essential to review at least 3 commercial bids of comparable merit, verifying tax identification numbers, 10, licenses, liability coverage, portfolios, and testimonials. The agreement should stipulate a staged timeline and payment upon successful completion, rather than an upfront 50% for a commitment. Any modifications require a formal written change order specifying the revised cost and duration. Maintain all correspondence and photographic records, and apply a 5 to 10% holdback until all noted deficiencies are corrected. It is more economical to lease tools than to purchase them for a single use. And when choosing materials, evaluate the total cost of ownership. A cheap finish that buckles after a year will incur greater expense over time. Occasionally, it is more sensible to rent temporary housing during the renovation period than to draw out the work through evening sessions, as time is also a valuable asset. Fact number 75. Taxes on investments are not the same everywhere. Countries have different rules, but the core ideas are similar. You can earn income from interest, dividends, or when the value of your investment goes up, capital gains. Trades made quickly are usually taxed more than trades held for a long time. It's important to track your lots, knowing when and for how much you bought something. This helps you figure out the correct cost when you sell only some of it. How you identify which items you sold, like FIFO, meaning the oldest ones first, or by picking specific ones, will change the tax amount. You can harvest losses by selling investments that lost money to cancel out profits you made elsewhere, which lowers your taxable income. But be careful not to do wash sales, where you sell something and buy it back right away. There are rules against this, and you must follow them. Asset location is a way to save on taxes. Keep investments that give you a lot of income now in special accounts that have tax benefits. Keep investments that are better for taxes in regular accounts. For investments in other countries, there might be taxes taken out where the company is, and agreements to stop you from being taxed twice. Keep all your bank statements, trade confirmations, and a schedule of when you need to report things. Paying fines is much more expensive than trying to save a little on taxes. Always check the specific laws in your country, but being organized with your records is always a good idea. Fact 76. The selection of an ETF hinges on its technical specifications, not its name or a pretty chart. Start by understanding what index the fund tracks, its selection and weighting approach, e.g. by market cap, free float, equal weight with liquidity filters, and its rebalancing frequency. Next, examine costs and actual performance, the on-paper TER versus the actual tracking difference, which incorporates hidden expenses and income from securities lending. Liquidity and spread are significant factors. Low AUM and a thin order book mean higher costs for buying and selling. Market orders are risky, so use limit orders instead. The fund's jurisdiction impacts dividend taxes and rules like UCITS. Replication can be physical or synthetic, involving swaps and counterparty risk. How dividends are handled, paid to you or automatically reinvested, affects your taxes. Finally, consider deviations from NAV during stressful market days. While ETFs typically track fair value closely, the gap can widen for niche themes and markets. Fact number 77 discusses how freelance pricing is structured, with the payment method influencing how everyone involved behaves. An hourly rate is clear, but can encourage tasks to be drawn out. A set price for a project eases a client's concerns, but it requires a very specific plan and protection against the project growing larger than agreed, usually through limits on how many times things can be changed and charging extra for new work. A retainer means paying for a freelancer's skills and ensuring they are available, but it must include service-level agreements and a clear description of what work will be done. A model where you pay for the results achieved is possible if you can measure those results. In practice, it's common to get 30% to 50% of the payment up front, with the rest paid as the project progresses through stages. Contracts should state who owns the final work, when payments are due, like within 7, 15, or 30 days, what happens if payments are late, and a fee if the project is canceled. Your rate should be based on how much you want to earn, how busy you are, and taxes, not just a guess. You can offer discounts for bigger projects or if the work is predictable, not just because someone asks. Keep track of your time and how much profit you make on each project. Always have some free time available. Don't accept every job that comes your way, and never charge less than it actually costs you to do the work, because doing so harms both the quality of your work and your reputation. Fact number 78. Extended warranties and accidental damage coverage frequently seem like a sensible precaution, but the financial aspect is governed by failure rates. The curve of technical failures is shaped like a bathtub. Initial flaws emerge within the first several months. These are covered by the basic warranty or exchange program. Then a prolonged phase of dependability ensues, and widespread deterioration occurs nearer to the conclusion of the product's operational life, when many are already contemplating a replacement. A purchased warranty is advantageous for the seller because the typical repair expense and the chance of an incident are less than the policy's price. For the purchaser, it is justifiable for product types with high repair costs and for usage that is delicate, such as portable electronics used by youngsters. Review the exceptions carefully. Dampness, screen issues, battery aging, and unauthorized repairs are commonly excluded. Deductibles and payment caps will reduce the amount paid out. Be aware that some bank cards will double the manufacturer's warranty duration. This is a no-cost equivalent. A different strategy is a repair savings account. Regularly put aside a small fraction for upcoming malfunctions and replace your gadget based on its total cost of ownership, TCO, rather than on the basis of insurance. Fact 79th. Dealing with digital inheritance and access to money is an uncomfortable but financially crucial matter. Your passwords should be kept in a manager that offers an emergency access option for a trusted person and have a separate master key stored offline and sealed. Do not rely on a single SIM card for two-factor authentication, as SIM swap events can happen with mobile operators. It is advisable to use app-based generators. Print your backup codes and store them with your paperwork. Keep hardware keys in pairs, stored in different locations. For each financial service, record the login email, methods for account recovery, account number, and any beneficiaries named. This is because many assets can be transferred via named instruction more swiftly than through standard inheritance proceedings. Set up inheritance access or trusted contact features with major platforms. Provide clear, simple instructions. Detail the location of accounts, the process for paying utility bills, and who should be notified. Conduct yearly practice runs to ensure all access methods are working and current. In times of crisis, it is preparation and clarity, not technology. Fact 80. 0% installment plans and BNPL options are not consistently free. Often, the cost is not expressed as interest, but as a missed discount for immediate payment, additional services that are added on, and penalties. Compare two statements, the price under an installment plan versus the price for paying with cash. The difference between these two figures reveals the effective cost of the credit. To this, add the fee for setting up the plan, insurance for your payments, charges for SMS alerts, and a potential higher final payment. It is important to read the payment schedule carefully. If you miss even one payment, the 0% rate will be replaced by the standard high interest rate for the entire remaining amount. An installment plan can reduce your available credit limit with a bank, negatively affecting your credit utilization ratio, which in turn can temporarily increase the cost of other loans you may have. BNPL services break down a purchase into small payments, which can mislead your perception of the actual price. It is recommended to set spending limits and arrange for automatic payments. Avoid using multiple installment plans simultaneously at different stores. If you have the cash available, try to negotiate a discount and calculate the total cost of ownership. Sometimes it is more sensible to pay a smaller amount today than to pay more later in a way that goes unnoticed and seems trouble-free. Fact 81. There's a difference between inflation in general and your inflation. The official index is an average, like a hospital's average temperature. The basket of goods and services is averaged across regions and households. The methods factor in changes, like people switching brands, seasonality, and even quality. A new model might cost more, but its price per function is comparable. In reality, your spending pattern is different. A family with kids is more affected by baby food and service costs, a remote worker by communication and electricity, and a renter by housing prices. So it's good to calculate your personal inflation yearly. Check your past spending categories against current ones, see what's rising fastest, and adjust your goals, insurance, and savings. Practical defenses include locking in rates where they're good, changing providers, saving energy, asking for income increases, moving some spare money from a zero-interest account to low-risk options that at least partly match price hikes. Fact 82nd. Policies on returns, warranties, and chargebacks are not just paperwork, but actual money that is often left uncollected. In numerous countries, distance purchases come with extended rights to refuse goods, while physical store purchases have their own time limits and procedures. Payment systems restrict the time frame for disputing transactions, after which getting your money back is not possible. Practical steps help save your money. Keep your receipt and contract. Record the unpacking of expensive electronics on video. Write down any defects the day you receive the item. Communicate via official support, and avoid messenger chats without a trace. If the seller is slow to refund, make a claim to your bank using the chargeback rule and include a timeline and proof. Do not sign and act without comments until you have checked the product. Do not agree to repair instead of refund if it goes against the terms. For subscription services, set reminders before the renewal date and save screenshots of your plan details. In a dispute, this can be the key to getting your money back. Fact 83rd. Passive income sounds like a desirable goal, but in reality, it's almost always either income derived from capital or income from a system you have built and continue to maintain. Dividends and coupon payments require substantial capital. Put simply, 5% annually before taxes means 50,000 units of currency for $1 million invested, and this is without guarantees of maintaining purchasing power. Rental income provides a flow of funds, but it is not free from periods of vacancy, repair expenses, and the need to interact with people. Royalties and income from digital products begin with months of work at the outset and require ongoing updates. Investments held under management remove the routine work, but they do not remove market risk and expenses. The true effectiveness lies in automation. This involves regular contributions to inexpensive index funds, automatic transfers, liquidity buckets, and clear rules for withdrawals. Everything else is an exchange. Either you commit more time and expertise, or you take on more risk and capital. If they promise high passive income without effort, it is generally marketing or a risky scheme. Fact 84th. A personal finance stress test is a paper simulation of adverse conditions designed to identify vulnerabilities early on. You should examine your budget and investment portfolio running through several hypothetical situations. A revenue decrease of 1/3 lasting for 6 months. A rise in interest rates for loans with variable rates. A significant increase in costs for utilities and insurance. A market value drop of 30 to 40% followed by a slow recovery. It is necessary to quantify the duration for which your reserves will suffice, the order in which essential payments will be reduced, the criteria and sequence for selling assets, the minimum expenditure level that can be maintained without incurring debt. For the investment portfolio, define rebalancing procedures and establish a liquidity schedule spanning 6 to 24 months to prevent the sale of high-risk assets during periods of their lowest valuation. Regarding debts, formulate a strategy for discussions with creditors and for refinancing, ensuring all required documentation is prepared beforehand. Furthermore, assess asset concentration, the proportion of funds linked to your employer, a single currency, or a single financial institution. The final output is a brief emergency protocol, complete with contact details and a checklist, enabling prompt and organized action when a crisis emerges rather than on-the-spot planning. Fact 85th. Location is a financial decision as impactful as career choice. Comparing a high-cost, high-income city with a low-cost, low-income city requires a post-tax, post-housing, and post-time cost analysis. Big cities offer higher pay and career opportunities, but also entail greater expenses for rent, transport, parking, and leisure. Suburban homes are generally larger, but this means adding car expenses, insurance, fuel, and non-investable commute hours. Remote work shifts the calculation. Income tied to a capital city's market, while expenses are regional, can turn the difference into a savings boost. However, factor in taxes, local premiums, healthcare, schools, and climate costs, heating to cooling. Hidden costs include utilities, local fees, property or auto insurance, and public transport access. Conduct a 3 to 5 year TCO analysis considering relocation probability over weekend fantasies. Where you live is a monthly financial engine, either accelerating or decelerating your progress. Fact 86th. The greatest potential for saving money is found not in small expenditures, but in the 3 primary expense categories: housing, transportation, and food. Renting a residence somewhat further from the city center, but with excellent transit connections, living with roommates, or choosing a smaller dwelling often results in a more substantial benefit than numerous minor adjustments. When owning property, the mortgage interest rate, insurance premiums, utility charges, and maintenance expenses have a greater influence on savings than insignificant household costs. In the realm of transportation, the total cost of car ownership, depreciation, insurance, parking, maintenance should be contrasted with the costs of public transit, car sharing, and occasional taxi services. Occasionally, selling a second car can result in monthly savings of hundreds. Regarding food, rather than concentrating on restaurant bills, it is more effective to alter spending patterns. Planning meals, shopping with a specific list, and preparing food at home reduce the inclination to make impulse food orders. The strategy of one significant annual change is effective because one structural adjustment can offset the impact of 10 minor ones. Trivial matters also hold importance, but solely after the big 3 expense areas have been regulated. Otherwise, it is akin to trying to bail water from a boat that is continuously taking on water. 87th fact. Identity theft is a financial emergency with a clear set of steps. Step 1. Record the incident. This means submitting claims to your bank and the police or regulator, blocking cards, changing passwords, and revoking active sessions. Step 2. Freeze your credit history where possible. This stops new loans from being opened without your consent, or at least triggers alerts for any requests. Step 3. Change your vulnerable identifiers. This includes your email, as it's often the root access, your 2FA numbers, and restoring access using backup codes. Also, protect your SIM card with a password from your carrier to avoid SIM swap. Step 4. Check your auto payments and linked accounts. Remove old devices and tokens. Step 5. Monitor your statements, credit reports, and government accounts like tax portals. Scammers take out loans, claim benefits, and even rack up fines using other people's details. It all sounds boring, using a password manager, hardware app keys, unique logins, and a separate money email. But this boring approach is cheap compared to years of arguments and a ruined credit score. 88th fact. When you buy discount points or refinance to reduce your interest rate, it's a matter of calculating the return on investment. You pay about 1% of the loan amount up front for each point, and in exchange, your rate decreases, for example, by 0.25 percentage points. The advantage is a reduced monthly payment. To determine the break-even point, divide the total cost of the points by the monthly savings. This figure represents the number of months it will take for the discount to start benefiting you. If you plan to sell or refinance before this point, the upfront expense won't be recovered. It's essential to consider taxes, insurance, fees, balloon payments, and situations where the seller or builder might cover the points as an incentive, as these factors change the calculation. For refinancing, the approach is similar. Sum all the one-time costs of the deal and divide by the difference in your monthly payment. Then compare this to your expected ownership period. Always check the annual percentage rate, not just the nominal rate, and avoid appealing offers that promise low monthly payments by extending the loan term, as this can lead to a higher overall cost. Fact 89th. FIRE. Financial independence, retire early, sounds like a pass to endless holidays, but it depends on rigorous discipline and realistic assumptions. The standard 4% guideline suggests an initial withdrawal of 4% from your portfolio, indexed for inflation. This is not a natural law, but a conclusion drawn from historical periods and currencies, and it is affected by inflation, taxes, and the order of returns in the initial years. More adaptable guardrails recommend reducing withdrawals in poor years and increasing them in good years, thus maintaining a stability channel. The structure of expenses, fixed variable, a liquidity reserve for 2 to 3 years, and income diversification are crucial. Side hustles, royalties, and projects decrease the risk of being born in the wrong decade. Medical insurance and taxes are separate items that are easily underestimated. FIRE is not about leaving at any cost, but about gaining the freedom to choose your work and pace when basic expenses are covered with a high probability. A conservative plan and stress tests are more valuable than romantic ideas. 90 facts. Employer and government benefits are essentially money on the table that are frequently missed. Employer matching contributions to pension funds effectively provide immediate returns on the invested sum. Corporate insurance, dental care, glasses allowances, EAP, employee assistance programs, compensation for education and certifications, and subsidies for commuting and meals all reduce personal expenditures. It is crucial to ascertain the access requirements, minimum employment duration, enrollment periods, personal contribution requirements, and course performance standards. State-sponsored programs include tax deductions for children and mortgages, rent and utility subsidies, low-interest loans, savings co-funding, and medical screenings. The specific list varies by country, but the underlying principle remains. Conduct an annual review of eligible benefits and gather supporting documentation. Often, employers also extend discounts with partner companies, covering services from telecommunications to fitness. These hidden budget items do not replace salary, but cumulatively create a tangible financial difference over time. Fact 91. The importance of a financial calendar surpasses that of a perfect application, as systematic habits are more effective than improvisation. Divide your year into key milestones. Payday is the time for automatic pay-yourself-first transfers to your savings, investments, and specific goal accounts. The beginning of each quarter is for assessing your net worth and rebalancing your investment portfolio. 1 month prior to annual expenses, such as insurance, taxes, or vehicle maintenance, ensure the relevant funds are pre-allocated. Seasonal expenditures also require financial foresight. Holidays, gifts, school-related costs, and heating expenses are best managed by distributing them in equal installments beforehand. A three-tiered approach to financial control is effective. Automate recurring payments, set reminders for infrequent transactions, and dedicate one money day monthly to review the period and identify any financial missteps. Implementing minor friction points can improve discipline. Use a separate card with a low limit for subscriptions. Place restrictions on transfers between accounts and institute a cooling-off period for substantial purchases. A calendar transforms financial management from a series of random occurrences into a predictable journey where unexpected events are less frequent and less costly. Fact 92nd. The designation of beneficiaries is a discrete process for transferring funds, which in many instances operates more rapidly and cleanly than a will. Accounts with the notation payment on death or transfer of rights on death direct the asset to the appointed person upon submission of a request and a death certificate, bypassing the usual probate proceedings. For retirement and insurance products, this is generally the foundational transfer method. However, the mechanism's influence is dual-sided. If a former spouse is specified in the application, they will indeed receive the money, even if the will indicates a different outcome. Consequently, the principle is to reassess beneficiaries with each significant life event: marriage, divorce, the birth of a child, a move, or substantial acquisitions. It is also important to establish proportions and designate reserve recipients in the event the primary beneficiary cannot accept the funds. Joint account ownership facilitates promptness, but entails risks such as access by the other party's creditors, conflicts, and tax considerations. Documents must align in full names and dates and be kept together with an instruction manual for loved ones for the first week. Paperwork clarity saves months and thousands. Fact 93rd. A domestic animal is not merely a source of delight, but also a sustained financial obligation with a foreseeable total cost of ownership. The initial expenditure encompasses immunization, microchip insertion and registration, neutering or spaying, a fundamental assortment of gear, a waste receptacle or travel container, and a claw-sharpening device or enclosure. Subsequent outlays include premium sustenance, annual inoculations and examinations, prophylactic measures against parasites, coverage through insurance where feasible, services for upkeep and grooming, and unforeseen consultations with a veterinarian. An urgent surgical procedure can equate to a month's worth of financial resources, necessitating either a policy or a dedicated pet fund in a separate account. Sojourns introduce expenses for animal boarding establishments or for the requisite paperwork and transit. Leasing premises may involve additional animal-related security deposits and fees for cleaning. The acquisition of inexpensive accoutrements frequently results in their periodic replacement. Superior quality items endure for extended periods and prove more economical over the long haul. Prudence is found in proactive measures. The accumulation of dental calculus, excessive body mass, and sedentary habits translate into expenses at the medical professional's office. When selecting a breed, it is advisable to consider hereditary predispositions and physical dimensions. Do not commit to the idea of managing finances as they come. The financial provision for the new family member must be established beforehand. Fact 94th. Renting a place involves a contract with financial considerations, and most issues are resolved when you first move in. Make sure to document the property inspection with a handover report that includes pictures or videos of any damage, the meter readings, and a list of all the keys you receive. If you don't, your security deposit could become a disagreement based on just what people say. It's important to carefully read the parts about ending the lease early, how rent might increase over time, and what's included in utility bills. You need to know whose name is on the utility accounts, which services are covered, how payments will change if prices go up or if there's an inflation adjustment, and who is responsible for small repairs versus major ones. Check if you're allowed to sublet or have pets, and if there are penalties for having more people living there than agreed upon, because breaking these rules can end up costing more than you expect. Also, be sure to ask about how much notice you need to give before moving out and how you'll get your security deposit back, including the bank details, the deadlines, and any reasons why money might be kept. Following good practices means paying only as per the contract, not with cash. Getting renter's liability insurance and having a separate bank account for utilities to track your spending are also recommended. Starting the rental process correctly can save you stress and a lot of money later on. The 95th fact emphasizes that hobbies and the equipment needed for them operate under the same total cost of ownership (TCO) laws as vehicles. The cost is incurred per hour of use, not just at the point of purchase. For a camera, this includes not only the camera body and lenses, but also memory cards, batteries, a bag, a tripod, software, maintenance, and depreciation. Similarly, a bicycle requires ongoing costs for maintenance, tires, tools, storage, and protective gear, beyond the initial frame purchase. The 100 hours rule is a useful guideline. If you anticipate using the equipment for at least 100 hours within the first year, purchasing a mid-tier option is justifiable. If not, it is advisable to start with rentals, a refurbished used item, or access to a club's equipment or workshop. A pilot test is recommended. Renting for a month with use spread over 2 or 3 consecutive weekends offers a practical understanding of your usage patterns without the psychological burden of wasted money. Plan for eventual resale from the beginning. Choose brands and models that hold their value well and keep original packaging and receipts in good condition to minimize depreciation when you sell. Budget for consumables and training up front. Learning from professionals is often more economical than going through many instances of trial and error. This approach ensures that your hobby remains a source of energy and does not become a consistent drain of unpredictable expenses. The 96th fact states that a major purchase is akin to a mini project with defined stages, and it's the process itself that ensures cost savings. The process begins by clearly stating the purpose, what problem the item will solve, its estimated real usage in the first year, in hours, kilometers, or sessions, and what other options are available, renting, buying used, sharing, or the service instead of ownership model. Next, the total cost of ownership is calculated over a time frame, including the price, delivery registration fees, accessories, insurance and maintenance, consumables, and the expected resale value loss. If a 0% installment plan is offered, it's compared to the cash price. Following this is a trial period. A test drive, a weekend rental, or a month of demo use is the best way to avoid fooling oneself. A cooling-off period of 48 to 72 hours is introduced, along with the rule to pay only from the goal's savings, not from credit. Return policies and the availability of nearby service are checked. The final step is the exit plan, assessing the model's liquidity and its resale discount. This kind of checklist prevents impulsive buying and saves significant portions of the budget. Fact 97th. When selecting a financial advisor, consider the framework of their interests. The core inquiries are: whose interests do they prioritize, and what is their compensation structure? The fee-only approach mitigates conflicts by charging a fixed fee, an hourly rate, or a percentage of the client's assets. The fee-based model blends direct fees with commissions, whereas commission-driven models rely on selling products. Clarify if the advisor has a fiduciary duty, meaning they must place your interests ahead of their own, or if they operate under a more lenient suitability guideline. Check their registration and any disciplinary history with the governing regulator. Identify the custodian of your assets and determine if the advisor can manage your money without your specific authorization. Learn how they profit from insurance, funds, and loans, and insist on a complete breakdown of all commissions in both percentage and dollar terms. Request a sample investment policy, the format for reports, how often you will meet, and a plan for handling emergencies. A crucial test of their integrity is their willingness to state that a particular product is not for you, and their capacity to work with your budget and risk tolerance, not just to pick funds. Fact number 98. A market bubble rarely makes a grand announcement. It's indicated by credit leverage becoming common among the public, new paradigm appearing in headlines, and everything growing simultaneously without quality distinction. The signs are a rapid influx of new investors, stories of quick wealth, aggressive leverage tools for individual investors, companies with no profits trading on far future projections, and explanations such as, "This time is different." The defenses are simple and unglamorous. Set limits on how much of one asset and sector you hold, forbid margin for long-term investments, rebalance within set ranges, have a written investment plan with clear danger zones, and keep cash reserves so you don't have to sell when prices are low. Practicing forward-looking caution is helpful. Assume future earnings will be less than recent ones, and don't base your plans on the charts from the past 2 years. And always remember, even if the bubble isn't where you think it is, sticking to discipline and spreading your investments will help you through more situations than any exciting story. Fact 99th. The movement of money internationally is subject to 3 main sets of rules: payment channels, currency controls, and tax laws. When evaluating a transfer, the overall expense is taken into account: your bank or services commission, fees from intermediary banks, the exchange rate margin, and the time for funds to be credited. In some cases, sending funds in the recipient's local currency for them to convert can be more economical. KYC/AML standards require documentation proving the origin of funds and the payment's objective. It's important to keep contracts, invoices, and statements. Some nations have limits on taking currency out of the country and require reporting on foreign accounts. Other nations require the declaration of foreign assets and income. While agreements to avoid double taxation exist, their implementation requires a specific procedure involving certificates and forms. Compliance is serious. Attempting to use unofficial workarounds can lead to account blocking. The straightforward approach is to learn the rules of both jurisdictions in advance, distribute risks among different providers, perform a test transfer, record the exchange rate, and allow for a buffer of time as crossing borders creates more obstacles. Fact 100. Personal finances are mastered not by the flashiness of ideas, but by the consistency of systems. Income is raised through skills and negotiations. Expenses are managed through the big 3 categories. Risks are neutralized with reserves and insurance. Debts are kept in check. Capital is built with low-cost, diversified tools, and decisions are formalized in a calendar, governed by rules and policy. Automated contributions and goal savings pots assist you on days lacking willpower. Bookkeeping and quarterly financial reviews re-establish a link with reality. Portfolio rebalancing and spending limits shield you from emotional decisions. Proper documentation and designated beneficiaries save loved ones months of effort. While the world evolves, the core principles endure. Spend less than you earn, prioritize saving for yourself, steer clear of expensive errors, appreciate liquidity, consider the total cost, and acknowledge risk. This is not sorcery, but a trade, and it is effective when practiced.